Don't make me angry. You wouldn't like me when I'm angry. Jay Powell became Bruce Banner yesterday. He turned into the Incredible Hulk right before our eyes. It was clear the chairman of the Federal Reserve actually came into yesterday's press conference with a chip on his shoulder. His goals were clear, including pushing back against the notion of a step down. He also banished that Wall Street Journal reporter who brought that. He was usually number one. He pushed him way deep into the queue. Powell also seemed to be upset with forces within the Fed that implored him to bring up the lag effect of tightening and also accumulation, sort of like that BLT scene with Eddie Murphy and Trading Places, duh. But it was that question 36 minutes into that Q&A that sent Jay Powell over the edge and further off script.
It looks like stock and bond markets are reacting positively to your announcement so far. Is that something you wanted to see? Is that a problem?
Whoa. Powell's frustration grew, and it was pretty clear from there. This mild-mannered Fed Reserve chairman had morphed into an indiscriminating green wrecking machine. The stock market got the message loud and clear, folks, beating a hasty retreat. Take a look at this. We've never seen this before. From 232 to close on a Fed day. This is the biggest drop ever. Look how far back you got to go. Never did we see this before. That last 1 hour and 30 minutes was treacherous. This morning, of course, we all got up. We wanted to see, well, what's the market thinking here? So we go and look at the Fed CME Fed Watch. Interesting. So we do see a big 75%, 7.75% move there. We see another move here. What caught my eye, though, is now the new terminal rate, 5.25 to 5.5. That's huge. Also, though, this is going to wreck the economy, according to Wall Street. The Fed's going to have to cut and cut again. So is that the new path? Also, of course, what this all means for the street, looking for Powell because they don't want him to go too far and then have to cut and then cut. I want to bring in now Bianco Research President Jim Bianco. And Jim, lots of misdirection yesterday. A dovish statement and tone initially turned very quickly to a hawkish stance and a tone that was devoid of any empathy, humor, or any compassion. Your thoughts on what we witnessed?
Well, I think the dovish statement is a signal that there's not unanimity within the Fed. There are some people like Lael Brainerd, the vice chairman, that don't agree with this policy, but Chairman Powell gets Chairman Powell's way. And he made it very clear in the press conference. He views inflation as the #1 scourge in the country, and he might not be wrong on that. And he views the best way to get inflation down is a reverse wealth effect. He can't have investors make tons of money like they did last year when the stock market was up 29%, because that'll just spur demand and push up inflation even more.
So, Jim, you put out a chart that, and it's all over, by the way, FinTwit, like everyone's gravitating to this chart. You see the terminal rate around 5.1. But as I showed earlier, you had the CME Fed Watch model at 5.5%. So what gives here?
Yeah, I think that the chart you're looking at was a little bit dated. And the CME it's actually been moving up. But what the chart is showing is that's the new metric that Jay Powell wants us to look at. Not how much they're going to raise in December. It almost doesn't matter if it's 50 or 75. The terminal rate is the fancy word we use for where's the Fed going to stop raising rates. And we're off into the 5 handles, 5.10, 5.25, maybe as high as 5.50. Interest rates are in the high 3% range, and some of the short rates to the low 4% range for the 10-year note. It's got a lot more room to go higher. This is going to keep the stock market on edge if we've got much higher interest rates in store.
So you mentioned it's pretty clear what Powell's focused on, and he made it clear over and over and over again yesterday. But what about the notion about us, of the investors out there? The idea that the Fed doesn't care about us, he doesn't care about our feelings, he doesn't care about our investment portfolios. I mean, people feel like rudderless ships out there because the Fed was our friend for a very long time.
Yes, the Fed was not only your friend, but it was also the creator of some higher markets. That's not the case anymore. And so investors are going to have to understand that when they invest, they have to invest in stuff that could withstand higher interest rates. And as we found with the overall level of the stock market, it doesn't really like much higher interest rates. That's why it's been suffering all year. So, yeah, this is going to be a very challenging environment. It's not over yet. Maybe 2023 it would be, but we're not in 2023 yet.
So then let me ask you, because the markets obviously are doing what the Fed wants it to do, right? The jawboning works. What's the metric? And it was, I think they tried to get it out of Powell yesterday, right? And he went into the different areas and he talked about pace, but he didn't really give us something to hold on to, something to root for. Where do we see where the market, the worst case scenario is built into the stock market? Where can we start to guess that?
That is a very good question, and that's kind of where we're all searching for where that answer is. In lieu of that, what we need to see is weaker data, weaker inflation numbers, which we haven't yet had. And so Jay Powell could come out and be very forceful when we're producing 288,000 jobs in September and maybe 200,000 jobs in October if the estimates are correct. But that might be a very different case in the months into the future when we're producing no jobs or losing jobs. So that's really what investors are going to have to focus on is the economy itself. And that's the old saw that we've heard all year, right? Bad news is good news. Bad news, unfortunately, people losing their jobs might be what investors need to have. It's a terrible position to be putting us into, but that's where we are.
It certainly is. Jim, thank you very much. Always appreciate it. So long-term investors, right?